Well, good morning, everyone, and good morning, Cannabis. I have my new best friend, Nick Richards, and I'm not sure, are you related to someone from the Rolling Stones?
I am, yeah, yeah.
You're
I am.
Keith Richards' lost son. I thought so,
That's
right?
right.
Well, you
That's
look a
right.
little like him this morning, so I just wanted to point that out.
I
So
don't
Nick,
have my skull rings on, but I got my beads on,
oh,
so I'm
he's
all
got his
good.
beads on. Okay, he's got the Picasso. Is that a Picasso on the back? Is that a real Picasso or no?
Something my wife did. I don't know.
Okay, well, I say that all the time too. That's don't blame me. This is something my wife did. Anyway, Nick is with a law firm. I'll let him kind of explain what who the law firm is. But the reason I wanted Nick on this call is because this is kind of tax time, and so a lot of people are asking the question, well, how should they be filing their cannabis tax return so that they can mitigate 280E? And Nick and I have had many discussions about this. I want the audience to hear directly from Nick some potential solutions. And so, Nick, I'm going to kick this right off. So, is it just like the three bears with small, medium, and large, or is it? I know it's
And,
also
and
is it
280E is the
is the
orange or
I
the
don't know. It's probably more like the big bad wolf, I guess, because 280 is a big bad wolf. I can't kind of go from one metaphor to the next. But anyway, so you have three different, because I've read your stuff and we've been talking with clients. I've been working with you with clients. So I'm using Nick. So, all right, being right up front there. He's going to give you all the caveats, but there are three different um, proposed solutions, quote unquote, to dealing with or mitigating 280E. And I'm going to have Nick kind of go through each one of them. So, Nick, start with whatever one you like, but end with 471C.
perfect. Todd, thanks so much for this. Really appreciate it. I'm a partner at a law firm called Greenspoon Marder. We're probably the biggest large firm in the cannabis space, I think. We were first to have a dedicated cannabis group, and I joined Greenspoon Marder about 4 years ago, specifically because of the national scope that the firm brings. That you know, we are a firm that deals heavily in all aspects of cannabis. I'm the tax expert. I help folks with getting started right, understanding entity selection, and then getting in the right accounting method. And Todd, as you said, there's sort of three things out there right now that are still uncertain tax positions that need to be disclosed. We don't know if we're right or not yet, but they are based on sound legal principles. So the first one I want to talk about is what I call the 280E capital asset method. And the 280 capital asset method is based upon the idea that Section 280E doesn't permanently disallow deductions forever. It merely causes a suspension of expenses that cannot be deducted or included into cost of goods sold. And Todd, I think a good way to understand that is to go back to when 280E was first created. It was during the height of the war on drugs, right? And those people out there that are older like you and me will understand that everybody wanted to get on the bus with Nancy Reagan and fry eggs, right? And so they wanted to disallow everything, cost of goods sold and deductions, right? But they couldn't. But there's a whole group of tax experts on Capitol Hill that advises Congress on tax legislation. And they advised Congress that they couldn't disallow cost of goods sold because to do so would violate the 16th Amendment. Todd, the 16th Amendment is what has enabled our income tax system. And under the 16th Amendment, the income then is defined as gain, right? Classic gain, and as we all would understand it, what do you got in your pocket at the end of the day, right? That's gain, right? And that's how income is defined. And so, nevertheless, the system has also said that the U.S. Congress has the right to take away deductions. And so
Gotcha.
what's the difference now between these deductions and cost of goods sold? So cost of goods sold are specifically tied to the 16th Amendment of gain because you can't tax the revenue from the goods sold unless you give credit to the cost of the goods sold.
Right.
Because if you did, it wouldn't reflect the gain, right, from the goods sold. But deductions then in our system are a little bit different. Deductions are not the cost of the goods sold. And for a cannabis company, that's the only revenue they have. Deductions are different. Deductions are the cost of your business. And
Right.
because you haven't sold your business yet, the 16th Amendment requirement to accurately reflect gain hasn't been triggered yet. But that doesn't mean that they disappear. That just means that they cannot be used currently. And so the 280E capital asset method, proposes that those expenses are then capitalized and carried forward to the time when they can be recognized against income. And that could be for some companies on exit when they sell their business. And if you can use 471C, we're going to talk about that a little bit later, it could be under the 471C method that those expenses can then be recognized. That's our 16th Amendment. One of the important things about the 16th Amendment is to understand is that it wants to tie revenue to expenses. And that's why some expenses have to be amortized or depreciated over a period of years because they tie to the revenue over a period of years. Right. That's our 16th Amendment at work, right? So that's the capital asset method. And there's a case out there that supports it called CBS that is pretty effective. I'm not going to go into that now, but it really fits within our system. And frankly, it makes this square peg called 280E fit into the round hole that is our tax system. And it's a really exciting proposition for cannabis companies because early on, everybody assumed that once you call it a deduction, it's just gone. And Todd, that's just not the way our system works, right? So that's the 280E capital asset method. I think of that as kind of an overarching constitutional level method that sort of dictates then what happens underneath it. Todd, I'm going to talk about filing amended returns next, and then I'm going to go to section 471C at the end here. So we saw a recent announcement by Trulieve, a multi-state, very large cannabis company, that it had filed amended tax returns for 2019, 20, and 21 under the position that 280E no longer applied, and it asked for a $148 million refund. Wow. Todd, that's a good day, right? That's a good day.
That is a good day. Bad day for the government. Good day for cannabis.
Right. We don't know what's happened there yet. They haven't announced anything further. But other cannabis companies now are also in a position where they need to also take the same steps. And that's because, and I'll talk about this, that's because there's a real chance that Trulieve is successful, or that another case out there called Canna Provisions is successful. And if it is successful and you don't file amended tax returns to protect your ability to benefit after 3 years from filing the original return, you can't file an amended tax return. So you could lose the opportunity to benefit from Trulieve's bold first move if you don't act accordingly and file amended returns. So it's really important that companies understand that. Because we don't want to get down, it's going to take a while, right? We don't want to get down the road and think, oh gosh, I should have filed that amended return. I just lost multi-million dollars, right?
Right.
That could be a bad day, right?
Could be a bad day.
Yeah.
So
right? For accountants, executives, boards, everything, right? There could be lawsuits. It could get ugly. So what's it all about? What's it all about? So in 2005, there's a case called Gonzalez v. Raich. Gonzalez v. Raich involved the early California legalized model, medical marijuana model. When that legislation first was passed, a group of participants in California's program sued the federal government and said, hey, look, you can't keep marijuana scheduled under the Controlled Substances Act. That violates the Commerce Clause. The Commerce Clause now is the enabling, is the statute, is the power that the federal government has to enforce a lot of different priorities out there. And the Controlled Substances Act is one of them. And the Commerce Clause authorizes the federal government to regulate what is known as interstate commerce. Todd, interstate commerce is commerce that crosses state borders, right? Or has an effect on commerce that crosses state borders. And so under this Commerce Clause authority, that's the federal government has authority to regulate interstate commerce. But look, California's program was entirely intra-state. It didn't cross borders. It was California residents growing marijuana in California for their use in California. And so what the Gonzalez v. Raich held, though, is that even despite its intrastate nature, it had a substantial effect on interstate commerce because marijuana in California could end up somewhere else. You wouldn't be able to tell the difference between it and illegally grown marijuana. And
Right.
for that reason, the federal government needed to maintain a watertight system of illegality throughout the United States. Those two things were really important. That this uniform illegality under the Controlled Substances Act was the federal government's priority, and there was a finding that the cultivation and use of marijuana in California had this effect on commerce in other states as well. Todd, that was 20 years ago, right? And now, 20 years later, a lot has changed. Three things essentially have changed. Number one, the federal government is not enforcing the Controlled Substances Act in states where it's been legalized. As a matter of fact, there's a number of pronouncements that the government has made that it's hands off in those states.
Right.
There's the Cole memos of a couple administrations ago. There's the budget rider that prevents the Department of Justice from interfering in state programs. And we just see across the board, if it's legal in the state, feds are hands off. So the facts have changed dramatically. Another fact that has changed dramatically is seed to sale tracking. Seed to sale tracking ensures that marijuana stays in the state, is sold, consumed, or purchased. I guess you could purchase it in a state and drive across state lines, but it ensures that marijuana is also identified, and so it distinguishes state legal marijuana from illegal marijuana grown elsewhere. So that fact has changed dramatically as well. And, Justice Thomas came out with a statement about a year or so ago saying, hey, look, Gonzalez v. Raich doesn't look like it's good law anymore because of those change in facts. And that's now driving the companies to file amended tax returns under the position that 280E no longer applies. But look, Todd, there's two other big factors here as well. Number one, the Supreme Court has changed dramatically over the last 5 years, right? Sure. It's no longer, let's say, equally divided between liberal and conservative, right? It is dominantly conservative now, 6 conservative, 3 liberal justices. And the Commerce Clause and the expansion of the Commerce Clause is an area that the conservative court despises. And it wants to pull that back and get back to the original interpretation of the Commerce Clause. And we see that in a number of opinions that have come out recently. The other thing that's happened is that law has changed dramatically. In those recent opinions, they're not following that substantial effect doctrine that occurred under Raich. They're following other doctrines, and they're taking power away from the federal government and returning it to the states. And so the facts have changed, the makeup of the court has changed, and the law has changed. So there's a real chance this works, and that means people need to protect their ability to benefit from it 3-4 years when it gets to the Supreme Court, should it work, right? Look, Todd, I can't say that it absolutely is going to work. Who knows what's going to happen? There's some facts that aren't the greatest facts as well. But those 3 factors are really, really important. And they really kind of lead the charge in what we're doing to help companies take the position and protect their hand there.
Nick, can I interrupt to ask you a question about that?
Yeah.
What would be the downside to filing amended returns using that? I mean, is there anything, will you be put on a poster and, shot at sight? I mean, what's the downside if you know that there's an opportunity to get those refunds? And what's the downside if you don't do that, especially from
right? I think, yeah. So of course, penalties are the downside, and we are writing tax opinions to give cannabis companies shelter, so to speak, to file amended returns and not be subject to penalties. And the tax opinions that we're writing find what's called a reasonable basis for the position, and a reasonable basis along with disclosure. You have to tell the IRS what you're doing here, then protects you from penalties down the road. With that said, now what is the other downside? We might be wrong, right? And you could owe the tax and interest. Interest is almost never not applicable. It's automatic in our system. And if you owe tax, you owe interest on that tax. And that's just the way it goes. Todd, I think the bigger downside is in not doing it, because even a small cannabis company, this is millions of dollars. You know, you would be more than remiss if you miss the opportunity 3 or
I
4
would
years.
think. Okay, good. So
Yep.
you're going to go on to 471C, I think, unless
Boy,
you're speaking
yeah.
about.
So that's the third bear, right?
That's the right. That's the
You know,
last layer of the third. That's I figure I envisioned 3 decks, one a top, middle, and the lower, which is really kind of the base, and this is the third deck.
so first 471C is the small business exception, and it's only available for companies that currently have under 29 million in gross receipts. And there's some other ins and outs of that I won't go into. But if you're a giant company, you can't use 471C, and those giant companies are using more of that amended return
Right.
method that right. So 471C is a remarkable code section, and it does some things in our tax system that are kind of leave you going, huh? And that concept of income that I described in the 16th Amendment is bold in the 471C world. So before 471C, everything was subject to 471A. 471A says that the commissioner has the authority to set forth inventory regulations. Todd's that's cost of goods sold, right? And that authority then is so to clearly reflect income. And so before 71C, everyone followed those inventory regulations, and those regulations said certain things were cost of goods sold, and what wasn't cost of goods sold was a deduction, and it was disallowed under 280E. And it created massive pain in the industry, particularly for dispensaries. It doesn't impact a producer quite as extensively as it impacts a dispensary.
Sure.
So 471C came out in 2017. It was first available in 2018. And what it says is that 471A does not apply. And so long as the taxpayer reports their taxes according to their books and records, that it, quote, shall not fail to clearly reflect income. Todd, there's that word again, income, right? That's that constitutional level word, right? It means gain, right? And remarkably, generally it's the IRS that has the right to determine what is and is not income. Here, that right is given to the taxpayer so long as the books and records match the tax return. So it is amazingly powerful what 471C does. And it explains why the tax community kind of was taken off by it, didn't know what to do with it for a number of years. But nevertheless, it is being used widely out there now. We are helping a lot of companies use it in a responsible way to put additional costs into cost of goods sold, and then under the 280E capital asset method to capitalize those costs that aren't put into cost of goods sold in the year that they're paid or incurred, and then carry them forward to a later year where they can then be utilized under the 471C method. Todd, it seems to reduce down the 280E burden just in a middle of the road method by about half, which is big dollars, right?
Sure.
And look, what's the IRS think about this? So the IRS is strangely silent about this, beginning in a report that was put out by TIGTA. TIGTA is the Treasury Inspector General for Tax Administration. TIGTA basically audits the IRS and then issues reports. So it issued this report about the IRS's targeted 280E audit program. And at the end of the report, it says, well, gee, IRS, what do you think about 471C? There's these tax practitioners out there that say that you could put additional costs in cost of goods sold that you couldn't put into 471A for cannabis companies. What do you think? And the IRS responded with a very short response, and the whole thing was redacted. Todd, it was the only thing in that report that was redacted. The IRS is talking about targeting the industry and different ways to just create havoc and all this stuff. None of that's redacted. And suddenly this one comment on 471C is redacted. And that got a lot of our attention, right? And we started advising clients around 471C. Again, taking that 471C, our system recognizes that there could be areas in the tax world that are uncertain. And in fact, the IRS has been wrong many times. And so our system provides a mechanism to challenge the IRS responsibly and avoid penalties by disclosing what you're doing. And that's what we're doing. We're disclosing every one of these. And Todd, 3 years later, we've had some audits, and guess what? the books and records match the tax return, the IRS is issuing what are called no change letters. That means they're not challenging the position and they're letting it go. So it's a good day for the cannabis companies. Hopefully, again, it's not certain yet. We can't say that because we're getting no change letters that we're right, but we can say that maybe we're not wrong. It's hard to say what that means exactly. And again, the IRS doesn't want to talk about it. They just keep saying, yeah, we're not going to talk about it. But Todd, the crucial piece to the whole thing is that the books and records must match the tax return. 100%. You can't have two sets of books. You can't do anything like that. You have your 471c books have to be your day-to-day books that you are using in your business and that you use for all business things that you do. That is the crucial point. That is the one thing that the IRS has said publicly, is that they better match. And guess what? In the audits that we've seen out there, that's the thing that they're looking at closely. So 471c, everyone needs to understand it.
So you've given us 3 different options. And can you just quickly list them for us again?
So 280E capital asset.
280E capital asset.
Amended returns under the position that Gonzalez v. Race is no longer good law, and as such, 280E does not apply. And the 471C method. Awesome. That capital asset method could be used by both big companies and small companies, assuming it's right with disclosure. 471C is for small companies. And you know, the bigger companies can't use 471C, so they're challenging 280E with these amended returns, but smaller companies could be filing amended returns as well.
Well, Nick, this is great. So we're going to have you back on another podcast because there's a lot here, but why don't you tell folks how they can find you? If they're interested, where can they reach out to you to perhaps have a deeper discussion or even engage you for the help on this? Because I would strongly, this is my statement to the audience. This is not something you really want to do alone. I think you really do want to partner with a law firm like Nick's and use Nick's work, because it's, yes, you can always try to fix your own car. I haven't failed. It's not a good idea. But I think having a professional like us, Sachs, partnering with Nick is really powerful. But how can people find you, Nick?
Todd, I worked on my 1969 Buick LeSabre quite a bit when I was a younger man, and never turned out quite right. This is not a 69 Buick LeSabre that we're talking about, right? First off, you can contact me by contacting Todd. And look, I don't file tax returns. I work with Todd to get you to the right position on your tax returns. There's nothing stronger than a good team of a lawyer and a CPA working together on a tax matter. We don't do the same thing. We complement each other. So that's what I would say first off. Second off, I'm at Greenspoon Marder. My email is my name, nick.richards@gmlaw.com. And you can send me an email. I talk to a lot of people who aren't my clients. I do that free of charge. I want to help people understand what's out there. My phone number, 720-467. No, that's almost my home number. 720-370-1169. I'd be happy to talk to anybody out there. You probably could find me at an event out there as well.
Yeah.
Be it Benzinga or MGA Biz or whatever it is, all these events. Great to see the industry at those events.
Absolutely.
A lot of good friends that I've made over the years. I always appreciate that face-to-face.
So thank you, Nick. So I'm going to just say goodbye to the audience, folks. It's been really a pleasure. I think that there's quite a bit that we've heard and learned today, and stay tuned. Nick will be on again, and until then, I bid you a great day. Nick, thanks again for being
Thank you, Todd, and thank you, Sachs.
Okay, take care. Bye now.